I want you to answer this honestly. If you had $10,000 sitting in a savings account in January 2021, what is that money actually worth today? You earn some interest, maybe 0.5% a year, the national average. So your 10,000 became roughly 10,250. Sounds fine, but here's what actually happened. According to the Bureau of Labor Statistics, from January 2021 through January 2025, cumulative CPI inflation reached 21.5%. That $10,250? In real purchasing power, it's worth about $8,500 in 2021 terms. You didn't lose money on paper, but you lost everything that matters, what your money can actually buy. Nobody took it. No one robbed you, but it's gone. In June 2022, U.S. inflation hit 9.1%, the highest reading in 40 years. According to USA Facts, the biggest real wage gap occurred that same month. Nominal wages grew 4.8% while inflation ran at 9.1%, a gap of 4.3 percentage points in inflation's favor, meaning workers received a raise and still fell behind. For 17 months straight, from January 2021 to June 2022, prices rose 12.3%, while wages rose only 7.3%. Workers lost 5% of their real purchasing power in under a year and a half. Today, I'm going to show you the complete anatomy of how inflation robs you. Not the surface-level version you hear on the news. The real version, with real math, real sources, and real consequences. And more importantly, what you can do right now to stop leaving money on the table. Because the math doesn't lie, and once you see it, you can't unsee it. First, the fundamental question: what is inflation really? The textbook answer says it's a general rise in prices. But that definition was designed to put you to sleep. The real definition: inflation is the purchasing power of your money declining. The same dollars buy fewer goods and services. Nobel Prize-winning economist Milton Friedman stated this in a 1963 lecture in India. Verified by the San Francisco Federal Reserve, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in the quantity of output. When money supply grows faster than production, your dollars buy less. Let's put this in concrete U.S. terms. According to the BLS CPI data, $100 in January 2000 has the purchasing power of approximately $183 in 2024, meaning the dollar has lost nearly half its value in 24 years, even during a relatively low inflation period. Now, at the post-2020 surge, U.S. inflation ran at 4.7% in 2021, 8% in 2022, 4.1% in 2023, and 2.9% in 2024. Cumulative CPI rise from 2021 to 2024, over 21%. That's 4 years. 21% gone from the real value of every dollar you held in cash. Inflation has two faces. The visible face, prices going up. You see this at the gas pump, at the grocery store, on your rent invoice. The invisible face, and this is the more dangerous one. The money sitting in your bank account is losing real value, while the number on screen stays the same. Your account says $10,000 today, just like it said $10,000 2 years ago. But what that $10,000 can buy has shrunk. This invisible theft is the one most Americans never fully reckon with, until retirement, when it's too late to fix. Inflation doesn't hit everyone equally. This is one of the most important things to understand. Wealthy Americans, those whose assets are in stocks, real estate, and commodities, generally fare far better during inflationary periods. Their assets rise in value alongside inflation. But Americans on fixed incomes, retirees, salaried workers who don't receive raises, and those whose wages trail inflation, take the hardest hit. According to data from Visual Capitalist and the BLS, from January 2021 to July 2025, average hourly earnings rose 21.8%. But CPI rose 22.7% over the same period, leaving real wages down 0.7% cumulatively. Let me make this concrete. According to the TAMU research blog, in 2021, the BLS reported average hourly earnings rose 4.7%. Sounds great, but CPI rose 7.1%. Real wages, the inflation-adjusted wage, declined 2.3%. Workers received a pay increase and still lost purchasing power. The TAMU researchers described this plainly. Workers actually had a decrease in the purchasing power of their wages. Their real wage decreased by 2.3% in 2021 because price increases exceeded wage increases. A raise on paper, a cut in reality. Retirees face the most brutal version of this. Social Security cost of living adjustments, COLAs, are tied to CPI measurements. But many retirees find their actual cost increases, particularly in healthcare and housing, run faster than the official CPI basket. According to BLS data, shelter inflation, which carries 36% of the CPI basket, was among the most persistent categories. From 2022 through 2024, shelter costs rose dramatically, compressing the real purchasing power of fixed retirement incomes across the country. But the biggest victim of all? Anyone keeping significant cash savings in a low-yield account. When the savings account rate is 0.46%, the FDIC national average, and inflation runs at 7, 8, or 9%. Real interest rates are deeply negative. You're earning money and losing ground simultaneously. This exact scenario played out for millions of Americans between 2021 and 2023, and many still haven't corrected it. Now let's see the math clearly. There's a concept called the Rule of 72, documented by the Mises Institute and foundational to financial mathematics. To find how long it takes for inflation to cut your purchasing power in half, divide 72 by the inflation rate. Example, at 7.2% inflation, 10 years to cut purchasing power in half. At 9%, 8 years. At 3%, 24 years. During June 2022, when U.S. inflation hit 9.1%, 72 divided by 9.1 equals 7.9 years. If that rate had continued, your purchasing power would have halved in under 8 years. It didn't last, but the damage in 17 months was already severe. Let me show you two real scenarios. Same income, same time period, completely different outcomes. Sarah earns $70,000 a year. In 2020, she has $50,000 in a regular savings account earning 0.5% annually. By 2024, her account shows $51,000. On paper, she grew her money. In reality, cumulative CPI from 2020 to 2024 rose approximately 21%. That $51,000 in real 2020 terms is worth about $42,000. She actually lost $8,000 in real value while watching her balance go up. She didn't feel robbed, but the math says she was. Now, James, same period, same starting income. He split his $50,000, 1/3 into an S&P 500 index fund, 1/3 into I-bonds when yields were above 9% in late 2022, 1/3 into a high-yield savings account at 4 to 5%. By 2024, the S&P 500 returned approximately 26% in 2023 and 25% in 2024 alone. The I-bonds locked in inflation protection above 9% for their initial period. The HYSA generated 4 to 5% throughout. James's real purchasing power didn't just survive inflation, it grew significantly ahead of it. Same income, same time, completely different approach. The lesson of these two stories is one sentence. In an inflationary environment, holding cash is not safety. It's a guaranteed slow loss. Cash doesn't protect you. It erodes you. Your money must work. And how to make it work. That's exactly what the rest of this video covers. First, inflation-protecting asset, equities, specifically broad market index funds. Historically, the S&P 500 has returned an average of approximately 10% annually over long periods, well above average inflation. More importantly, companies can raise prices during inflationary periods, protecting their revenue. The S&P 500 rose 26.3% in 2023 and 25% in 2024, both years when inflation was still running above the Fed's 2% target. Warren Buffett said it plainly: "The best protection against inflation is a wonderful business." Through index funds, you own hundreds of wonderful businesses simultaneously. Second, inflation-protecting asset: Treasury inflation-protected securities, TIPS, and I-bonds. These are U.S. government-backed instruments specifically designed to move with inflation. In 2022, when inflation peaked, Series I savings bond yields reached 9.62%, above the inflation rate itself. Available directly through treasurydirect.gov with no fees. TIPS are available through any brokerage. Both instruments guarantee your principal keeps pace with CPI. They don't grow your wealth significantly, but they prevent the invisible theft. Third, inflation-protecting asset: real estate. Home prices historically rise with or above inflation over long periods. The S&P CoreLogic Case-Shiller Index showed U.S. home prices rose dramatically through the 2020 to 2023 period, significantly outpacing CPI. REITs, real estate investment trusts, allow you to access real estate returns without buying physical property. Traded on stock exchanges. Available in any brokerage account. The limitation: real estate is illiquid. You can't sell a house in an emergency. REITs solve that problem. They trade daily like stocks. Fourth, inflation-protecting asset: commodities, particularly gold. Gold has been used as a hedge against inflation and currency devaluation for thousands of years. During periods of high inflation and dollar weakness, gold often appreciates. Ray Dalio's all-weather portfolio allocates 7 to 8% to gold specifically for this purpose. Gold ETFs, GLD or IU, make this accessible to any investor without physical storage. Fifth, and most accessible for beginners: high-yield savings accounts. Currently yielding 4 to 5%, still above recent inflation levels. Full FDIC insurance. Complete liquidity. Your emergency fund should live here, not in a regular savings account paying 0.46%. The single biggest mistake Americans make during inflationary periods: waiting. I'll invest when the market calms down. Let me save a little more first. I don't want to risk it right now. Every one of these statements, while feeling prudent, is actually the most expensive decision possible. Warren Buffett identified inflation as an invisible tax on savers. Inflation is a far more devastating tax than anything that has been enacted by our legislatures. And unlike income taxes, there is no exemption, no deduction, no filing extension. Every day you wait in cash, the meter runs. The second biggest mistake: concentrating everything in one asset class. Putting everything in stocks, vulnerable to market downturns. Everything in cash, guaranteed real loss during inflation. Everything in real estate, illiquidity risk. Everything in gold, no income, high volatility. The solution is what Ray Dalio calls the all-weather portfolio. Assets that perform in different economic environments, so no single macro event wipes you out. Stocks for growth. Bonds and TIPS for stability. Gold for currency protection. Cash for liquidity. Each serves a different function. Together, they protect in almost any environment. The third biggest mistake: measuring returns in nominal terms instead of real terms. You earned 5% last year. Great. But if inflation ran at 3.5%, your real return was only 1.5%. You earned 8%? At 5% inflation, real return 3%. This is why every investment decision must start with one question: am I beating inflation? If the answer is yes, you're building real wealth. If the answer is no, regardless of what your account balance shows, you are moving backwards in real terms. Your action step this week: calculate your real return on every major savings or investment account. Subtract this year's inflation rate from your annual return. That number is your actual progress. The U.S. isn't the first country to face serious inflation, and the global record is instructive. Brazil in the early 1990s experienced hyperinflation exceeding 2,000% annually. Citizens cashed their paychecks and ran to the store immediately because money lost value by the hour. The 1994 Real Plan, anchored by monetary discipline and central bank independence, brought inflation to single digits. By contrast, Argentina, which has repeatedly failed to maintain monetary discipline, is still fighting inflation above 100% annually today. The difference: institutional trust and monetary policy commitment. The U.S. Federal Reserve learned this lesson and moved aggressively in 2022 to combat the post-pandemic surge. At the individual level, Americans who successfully protected their purchasing power through the 2021 to 2024 inflation surge shared a common pattern. They acted early, moving savings from low-yield accounts to HYSAs in 2022 when rates began rising. They diversified across equities, TIPS or I bonds, and real estate or REITs. And they invested consistently through dollar-cost averaging, putting in a fixed amount every month regardless of market conditions. This strategy, available to anyone at any income level, is how real purchasing power is preserved and grown over time. Ray Dalio's fundamental advice for inflationary periods: cash is trash. His exact words, delivered at Davos in 2020 before the inflation surge, proved him right. Don't hold cash. Own assets. This counterintuitive advice, holding real assets instead of dollars during inflationary periods, is precisely what separates the people who maintained purchasing power from those who watched it quietly disappear. You now know this. The next question is whether you'll act on it. Let's summarize what you learned today. Inflation is the silent thief of purchasing power, operating whether you notice it or not. From 2021 to 2025, U.S. cumulative inflation exceeded 21%, while the average savings account paid less than 0.5%. Assets that protect you: equities and index funds, TIPS and I bonds, real estate and REITs, gold and commodities, high-yield savings accounts for liquid cash. The three biggest mistakes: waiting in cash, concentrating in one asset, and measuring returns in nominal rather than real terms. And the one rule that changes everything: always ask, am I beating inflation? 3 things to do this week. Move your emergency fund to a HYSA. Open a Roth IRA and start an S&P 500 index fund. Calculate the real return on every account you own. The math never lies, and the math says doing nothing is the most expensive strategy available. Every year you hold uninvested cash during inflationary periods, you are choosing to pay an invisible tax on your own future. You now know how the system works, and knowing is where action begins. If this video gave you something real, share it with someone who needs it. Subscribe for this kind of research-backed content every week. And drop in the comments, which number surprised you the most? I read every single one. See you in the next one.